Hello and welcome. My name is Joe Cass, Senior Director at S&P Global Ratings and the host and creator of the Fi15 podcast. On this episode, we had James Keenan, Chief Investment Officer and Global Head of Private Debt for BlackRock, alongside Ruth Yang, Managing Director and Global Head of Private Markets and Thought Leadership at S&P Global Ratings. Quick reminder that the views of the external guests are their views alone, and they do not represent the views of S&P Global Ratings. Okay, thank you so much, Jim and Ruth, for joining today. Ruth, welcome back. Would you be able to provide the audience with kind of a Dummies guide overview of the different areas of private markets, including things like secondaries, NAV lending, asset-based lending, and synthetic risk transfers?
Sure. So I think one of the challenges of explaining private markets, right, is that they are constantly changing and evolving. They're responding to changing market dynamics. So the elements that you just raised are an important part of the market today. I would guess that tomorrow, as market conditions change, those elements will also evolve. Particularly in private markets, change drives change. And so let's start with the basics, and then we'll kind of come back to the specific elements you called out, right? So fundamentally, private credit consists of, I like to think, three parties. One, there's the general partner, the private equity who's raising investment funds from. Number two, limited partners who are looking for a strong total return ROI, which is based upon buying and selling assets. The fund is the structure in the middle that holds the investments, the company buyouts, the real estate, the infrastructure, whatever it might be. And then these investments are levered. The fund only provides a piece of the buyout funding, the equity contribution, and the rest of the funding is borrowed against the valuation of the asset being acquired. This is really where the third party, the lender, provides funding. So lenders fund the buyout deal and subsequent debt raised, and this is how the traditional loan and bond markets kind of fit into the equation. Their investment return is the interest income off of the money that they're lending. It's important to note that there is a correlation between the lenders and the LPs, right? This is the institutional market, pension funds, endowments, family funds, insurance companies. They also, and then of course, fund structures will act as a lender as well. For example, a BDC in the US is a really good example of how a fund structure lends, and then they open up kind of the investment in the asset class to US retail investors. Ultimately, I think where we are today is the rise of fund financing, NAV, subline feeders, the evolution of ABS, SRTs. This reflects the impact of today's changing and challenging market conditions. For private markets, higher for longer has resulted in a turn to alternate methods of raising liquidity in response to slowing fundraising. Public markets are also responding, but they're less dynamic and they're less adaptive. We see the rise of these elements in private markets because they can innovate to changing market conditions. And this is why we're seeing all of these market structures kind of come front and center. And then, but fundamentally, I always remind people that that three-party structure remains the base foundation of private markets.
Excellent. Thanks, Ruth. Jim, can you share with the audience your roles, your responsibilities, and why private markets are such a growing area for BlackRock?
Sure. Thanks, Joe. And I'll take some of the things Ruth said as well and tie it into how we're building our business at BlackRock. But in general, I would say, private markets is a very, very broad term, and private debt is a broad term. And I would say, what the last 10 years looks like in private debt is going to be different than what the next 10 years looks like. And as Ruth said, it's an evolving kind of asset class. Simplistically said, the private debt is really that, I would call it transactions or loans that are private between the borrower and the lender. So a lot of the information around that loan is not necessarily public. And so it's harder to kind of price or trade kind of in the kind of the global markets. That being said, those underlying assets of those loans can be very, very broad, right? And so as we think about corporate or just generally fixed income, there are a lot of asset classes that make up the fixed income market, right? And think about private debt as the whole in the same thing. So we set up our organization at BlackRock to focus on 5 kind of verticals. You have your private corporate, you have real estate debt, you have infrastructure debt, you have things that we now refer to as kind of asset-based finance or ABLs. And then you generally have like your structured product or your securitized, which usually wraps a lot of the other assets that exist in the prior four verticals into a different structure for different risk points associated to that. So it's as broad as fixed income is as broad as the private debt ecosystem. As Ruth said, I think there's a lot of things that are evolving in the market today, right? And all of those asset classes have been traditionally banked asset classes where, the global banking system has lent on those behalf. And I think, with new regulation as well as innovation around different products, it is giving access to more and more people. So I would say on some side is there are people who want to own private instruments because of their yield and diversification, but they may want to own them unlevered. So there's a giant evolution of the private IG market, which a lot of our insurance accounts are looking for, and there's a lot of growth in that, all the way through different income products to things that might be more equity replacement, that more compete in that kind of 15% return profile. So think things like venture lending, opportunistic and distressed, and things like that, that might have a higher correlation to the equity market. So all of our clients are very interested because in many aspects, more and more of these assets or loans are becoming more investable today than they have been ever in the past because there's more available based off of regulation, but there's more innovation around products, in which case there's a interest in it. And simplistically said, clients are interested because of the yield enhancement as well as the diversification that they get that they can optimize their own asset allocation strategies by using. We're talking about trillions of dollars that become available for clients. And so if you're thinking about regardless of what kind of client, retail, institutional, insurance, that pool of assets is additive to building out your overall portfolio. And that's why clients are moving towards this space.
Fantastic. Thanks, Jim. Ruth, from a credit ratings perspective, what areas of private markets are we seeing interest in and from what type of investors?
Yeah, so I think sometimes there is this misconception, right, that ratings are purely a public market construct, and that's not true, right? Private markets, to Jimmy's point, is that there's there's a lot of things that are there that are transactions between insurance companies and arrangers, and those insurance companies will need a rating. Private markets value and utilize ratings. They are an important part of providing clarity and transparency on the risks of the instrument as well as to meet regulatory requirements. There's a lot of need for ratings. Insurance companies, institutional investors, banks all need ratings throughout this market. For private debt, of course, for example, we provide ratings, of course, on private borrowers in the broadly syndicated market, as well as associated investment vehicles, CLOs, prime rate funds. With the growth of private credit and direct lending, we rate middle market CLOs and have credit estimates on the underlying assets. And then with the rise of fund financing vehicles, where we started this conversation, bank, insurance lenders frequently need our ratings. So we see that our coverage of fund structures, as well as the associated NAVs, sublines, and feeders, is rapidly growing. And then for these same investors, again, a lot of the assets that Jim referred to, for these same investors, we rate an array of vehicles, including esoteric ABS, real estate structures, project finance, infra. There's a lot of touch points between ratings and private markets. In particular, right now, I think that as market conditions have become more challenging, there has been an increased push for ratings from both investors and arrangers. Investors, of course, not only want them for regulatory requirements, but they also frequently want them for risk management. And arrangers are increasingly becoming aware that asking for a rating helps to ensure a smooth and efficient syndication and funding process. I think what's important is that the need for a rating in this market isn't just about a regulatory requirement because that is minimal. It's really about ensuring that we provide a value-added insight on the risk based upon our very expansive understanding of credit markets.
Great. Thanks, Ruth. Jim, going into specific sectors, how are private markets supporting things like energy transition, and what risk can you see around the real estate space?
Sure. Very different questions at different parts. But I mean, at the end of the day, you think about it is what is credit doing, whether it comes through the channels of a bank or with the public markets or in the private markets, we're generally trying to fund businesses based off of what their optimal needs are in their capital structure, right? And Ruth kind of just outlined a whole series of things that create feeders in the private markets in order for us to kind of lend directly to those businesses. But so get to the energy transition. And there's a transition in energy, obviously, that a lot of people are moving from fossil fuels into a broader renewables, and that is it's permeating the entire, I would call it, microeconomy. And I would say when you think about that, add on the need for uh, energy for AI and the build out from AI, there is a massive amount of capex. You're talking trillions of dollars that need to get spent over the next decade plus to kind of one fund where the economy is going. So building all of the infrastructure needed in order to kind of build that power, the transmission of power, to help feed the kind of the future economy and where it is. And then on top of that is the transition from different forms and sources of that beyond fossil fuels, right? And so if you think about those projects, whether it's coming from a corporate or whether it's project finance, um, all of that is going to need funding associated to that. Is not just going to be equity funding, right? And so some of those may be very long tailored projects. And so our infrastructure debt business is very focused on that, working with many of these long tailored projects to fund that. But you are seeing that from a corporate debt standpoint as well. And so that is, I think private markets are going to play a very key role on that. And you think about some of these things are going to be either long dated or they're J curved in the sense that they don't actually have revenues up front because they're ultimately back end loaded as they get that infrastructure built. And so I would call it, all parts of the private markets are going to be one of the key sources associated to that. But with the magnitude, I would expect public markets and banks to also play very key roles associated to that. And I think those are all about growth, right? So just take away from energy transition, like the growth of the market, the microeconomy and different industries that we just touched on, and the evolution of that, private markets will play a key role in that. To your comment on the real estate side, which is a broad comment, but I would say the real estate is broken up into many different facets, right? And everyone generally focuses a little bit where there's been some, I would call it, more troubled assets, and that really being tailored towards the office space and really kind of more central business to office space. That is more tied into certainly, I would call it, the post-COVID trends with regards to working from home versus working from office and the utilization of that, the evolution of different technologies and the footprint of new buildings versus old buildings, and also the general shift in the economy and the population and where these buildings are. So there's still I would call it an idiosyncratic component in real estate, which is you have really strong infrastructure and buildings that are in very high demand, and then you have kind of maybe some older legacy buildings that are in less demand associated to that. So I would say, broadly speaking, you are going to see issues that will come up into, I would call the less desired office spaces. You are seeing some cracks in other parts of real estate, and I would call it more of the um, parts of the economy, even parts of like the multifamily or single family that might be more tailored towards areas of trouble. But we put that in a more benign environment. And so, in aggregate, I would say private markets is going to play across this overall ecosystem, no different than the public markets. I would say legacy economies and things that are maybe tailoring off, we lend to or may look at as either a more distressed asset or something that may roll off. Think about like the term IO or interest only, in which case you're funding that as it amortizes away. Car batteries are an example of this, right? There's going to be a car that's going to be in stocks in the next 20 years. It's not like we're moving to EVs immediately. And then there's all the kind of the growth parts of the economy as you see that continue to shift, and all are going to be important parts of the private market.
Fantastic. Thanks, Jim. And Jim, you kind of touched upon it there, but I'd be interested to hear your views on the evolving bank landscape. So the change in the size, the shape, and activities of banks, including a greater partnership with private lenders.
Sure. And yeah, there's a lot around this. I mean, first and foremost, banks are a great partner to almost every private credit manager out there. And we touch a little bit on this with regards to lenders across our funds, in many cases, their partners across our business. And this is around a market share shift that is being driven by regulatory environment. I mean, if you just look at the U.S. banking system, there's $23 trillion of assets on balance sheet. Europe is about 29 trillion. If you think about Basel III as written today, there are estimates that you would see about $3 trillion that would need to come out of the banking system. That would leave the US banking system about, 20 trillion. It's still going to be a significant partner across the ecosystem of other asset managers and private debt lenders, as well as corporates and infrastructure projects. That being said, all that means is that there's potentially a far greater, I would call it, loans or assets that are going to be available on behalf of the private debt and public markets, and no different than the trend you've seen over the last 10 years, right? And the importance of those markets. So this is all changing. Some of that is all regulatory driven in order to kind of, I would call it, stabilize or safer, make the banking system safer because they are deposit-based funding. And that's a big opportunity for us as asset managers, but it's a big opportunity for clients, again, because there's more accessibility with regards to these instruments for them to invest in. Now, there are two things around that, though. Part of that is some banks are going to be forced to deleverage, right? And that means they might be reducing assets on balance sheet. And maybe more of the regional banks that have been discussed are going to be more, that might be, I would call more constrained with regards to the types of assets, the region, the concentrations that they may have, and they may look to sell assets. Others might be more looking to optimize their balance sheets and think about that their RWAs or their risk-weighted assets may not be optimized in a way for them to make their return. And so you had mentioned SRTs or these structured risk transfers. These are ways that structurally banks can improve or enhance their RWA treatment, and as well are selling down assets from an economic standpoint. So like think about like a first loss tranche in a pool of assets that the bank retains. So this is all innovation. This is all, each bank is going to optimize their own way that they are going to create their own return. Simplistically for us, we're going to look across the entire landscape, whether it's a structured risk transfer or whether it's a pool of assets become available, to try to figure out how can we create strategies or returns and outcomes for our client base across all of these pools.
Great. Thanks, Jim. Ruth, what key risks should investors or would-be investors be aware of if they're looking to get involved in the private market space?
Yeah, so when Jim explains the market, right, over the last couple questions, it really resonates that there are a lot of risk factors, but they make sense when Jim talks about how the market works. And you talk about energy transition, for example, right? Everything they say about risks in the market are true, right? It's opaque, it's illiquid, and it has more risk in it because there's a lot of leverage and buyouts. This is a main part of the investment strategy. But it is really important to remember that these characteristics don't exist to make the market risky and complicated. They are a byproduct of the market structure and how it fits into the economy, basically. Private markets are opaque because they are largely unregulated. And to be fair, most transparency in financial markets occurs to meet regulatory requirements, right? Nobody really wants to show their hand unless there's an outcome that makes sense and and you have to do it. They are illiquid, but most of the borrowers and the assets, they need long-term committed capital. When we think about energy transition, right? These are long-term investments, venture capital, growth equity, the rest of infrastructure, digital transition, right? We're seeing this rise of data centers, real estate. These are all assets with long-term investment horizons. The investment strategy looks at total return, maybe buy and sell an asset. The illiquidity aligns with the strategic need for this long-term commitment. And then these are mostly spec grade transitions in private credit. M&A is the backbone of private credit. That's how you get these very nice ROIs, these total returns that are based upon buying and selling assets. So the illiquidity is related to the strategy, which then drives the return profile of these funds. For the most part, these are non-investment grade assets. I have definitely, seen what Jim talks about, which is the rise of investment grade. But the majority of these are really spec grade assets. But this is, not true of all assets, infrastructure, esoteric ABS. These also can be investment grade. The structures, middle market CLOs, These are investment grade for most of the tranches. Fund financing vehicles can be structured to meet investment grade rating requirements. As with everything, it's really important for investors to recognize the fundamental nature of any investment and the associated risk profile.
Hey, Joe, just to jump in there for a second too, just I want to, Ruth touched on the opaque nature, right? And I just want to clarify the opaque nature is for people outside the transaction. Inside the transaction, I think it's important to note that usually you have an information edge, right? In general, you are signing an NDA, you are getting the proper and usually a much greater detail of information that you might get in the public market between the borrower and the lender. And so it's not that they're opaque and you don't have the information. It's just that the bespoke transaction and the information shared is not shared more broadly. And that allows us as a lender to be more, I would call it, informed, to be able to structure that transaction to protect us as a lender. And I think that in general has led to lower loss ratios that you would see in the private market versus the public market. So the perception that opaqueness means more risk, I think is a false assumption, and it's proven out based off of by the loss ratios that you see in some private instruments versus the public market. The illiquidity comes from the reality is a third party can't price those instruments because they don't have the same information that exists between those two parties that are doing that bespoke transaction. And so you can still trade these instruments. It just may take longer. You have to run a process, sign multiple NDAs with people, get people up to speed. So the timing by which you might transact is going to be much longer than the public market. And on top of that, you're now seeing more evolution of things like um, uh, credit secondaries or LP secondaries that have, you've seen grow in private equity. I think you'll continue to see that grow in private credit as owners, LPs will want to, as they have more managers, more strategies, more vintages, they will ultimately look for more liquidity in different ways besides just selling the pool. And so I think this will continue to evolve, but I think it's important to understand the opaque nature doesn't mean more risk. The lack of liquidity doesn't mean more risk. It means simplistically that the markets can't price that at the speed at which, again, the public markets where things are more standardized or more public.
Great. Thank you both. Very interesting. Ruth, if you had a crystal ball, what would it be telling you private markets may look like in 5 years' time?
If I had a crystal ball, I don't know that I'd be here doing this role, but okay. You know, I don't think it's really a may. I think I can say fairly confident, right? Private markets are here to stay and they will continue to evolve as a third leg of the capital markets. Jim, you mentioned all the rising partnerships between banks and private credit. I think that is absolutely positively indicative of where we are going. Private and public markets will not become one market, but I think the efficiencies in raising capital in both markets for one transaction will increase. And I think that there's no doubt that these relationships between public and private will continue to strengthen, and we'll see a lot more of this. As a result, I think private borrowers will have a choice of bonds, loans, and private credit, and they're able to pick a capital structure that's tailored to meet their needs and risk profiles. And that is clearly in the best interest of capital markets across, in all aspects.
Perfect. Thanks, Ruth. Jim, high level question for you now. What opinion or view on investing do you have that few others would agree with you on?
Well, maybe I'll ask Ruth's crystal ball. I don't know if there's something that I have that is different than others. I mean, um, there's a lot of great investors out there and lots of different thoughts around that. I mean, I come more from a philosophical standpoint is, the world is always changing, technology is changing, markets are changing. So from an investment process standpoint, you want to stay disciplined. And one of those disciplines is constantly challenge your investment process the same way you would challenge your underlying assets or your loans, right? And so, uh, think about what's working, what's not working, and the reasons why. Continue to challenge that to kind of enhance your strategy. And if you just look at all of the tools that are available, the information, if you were static with your process, I would say you would be slow relative to adjust to all of the available tools. And you think about the growth of AI, all of these things are going to be incredibly additive about trying to come up with the proper information, the speed at which you're able to do that in order to come up with your investment thesis as well as your underlying portfolio construction. So I wouldn't say it's out of the norm, but I would always just say is challenge and enhance your investment processes and stay disciplined to them.
Great. Thanks, Jim. Ruth, can you name one person within S&P and one person outside of S&P you look to for inspiration or that you admire?
Yeah, so I'm going to take Jim's words about challenging and enhancing, right? And I think this is true of how I look at people who inspire me and how I want to be a better version of myself, right? So many people have inspired me, and for me, it's really never been about one person. As more like a being guided by a constellation of people, so that I'm constantly enhancing what I'm aspiring for myself to be. Outside of work, it's friends and family, as well as a mix of people who I've maybe met briefly, but their stories have really impacted and moved me. I don't think I can aspire to be one specific person, but to be the best version of myself, maybe based upon all these lessons that I'm learning from others. Within S&P, I have to mention that, I'm very privileged to be part of a company that has so many senior women in particular who can inspire me. They all impact me. I get to look and learn from them every single day. But also to Jim's point about how the world is changing around us, I just want to mention that I am always inspired by an amazing generation of younger female leaders who surround me. In my team, I work with Molly Mintz, Nicole Sereno, Yusheng Zhang, and each of them brings something unique to my world. And every day I learn something new. These women do the job of credit analysis and research, but they seamlessly weave in strategies necessary to meet today's digital world, right? They understand and execute strategies that incorporate digital engagement, social media, machine learning, generative AI. And it amazes me how they can do this and keep us at the forefront of the market. If you left me in charge, I'd still be writing things, in a notebook and printing things in paper. So I'm immensely grateful to them.
That's great. Thanks, Ruth. Jim, last question goes to you. Over the course of your entire career, what's maybe the best piece of advice you've ever been given, and who gave it to you?
The best advice, maybe as Ruth said as well, there's lots of people who have given advice along the way. I would credit my dad. Early days, very early days. I think I was probably maybe 10 or 11 years old. He had me on a Saturday tiling our bathroom, and I was looking to probably cut corners and go outside and play. And I just remember this. My dad looking at me like, if you're going to do a job, do it right. And, the simplicity of that is, don't be complacent, right? Be organized, be structured, be efficient. And, I think I've kind of approached work in the same fashion or form, which is, again, in our investment world, there's a lot of people doing it. You are trying to create outcomes, but there's an enormous amount of, I would call it, process that kind of goes into that. And so, that's something that always stood out to me from advice from my dad. So I'll give him credit.
Fantastic. That's great. Thanks, Jim. Thank you so much to you, Ruth, and you, Jim, for your time today. For everyone watching and listening, see you next time on Fixed Income in 15.